Ladies and gentlemen, good day and welcome to the Sobha Ltd Q1 FY2024 earnings conference call hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the call, please signal an operator by pressing star and 0 on your touch phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Adhidev Chattopadhyay from ICICI Securities. Thank you, and you, sir.
Good evening, everyone. On behalf of ICICI Securities, I'd like to welcome everyone to the Sobha Ltd Q1 FY2024 results call. Today from the management we have with us Mr. Jagdish Nangineni, the Managing Director, and Mr. Yogesh Bansal, the Chief Financial Officer of the company. I would now like to hand over the call to the management for their opening remarks. Over to you. Thank you.
Good evening, everyone. Thank you, Adhidev and team, for your kind introduction and for organizing this call. Sobha team and I are happy to interact with you post financial results of Q1 this financial year 2023. The investor presentation based on the audited financial results adopted by the board can be accessed from sobha.com. In this call, I would like to touch upon our last quarter performance and briefly on the outlook for the remaining period for this financial year. Q1 of FY23 has been a good quarter for us, both in terms of sales and cash flows. We achieved record sales this quarter again in terms of sales value at 1,464.7 crores. We sold 907 homes, comprising a total area of 1.39 million square feet. We did not have any new launches during the quarter, and hence the sales performance is even more remarkable. Due to the shift in the mix of sales and better pricing, the average price realization improved sequentially from previous quarter by 6%. Going forward, the pricing seems to be stable and to a marginal increase as we launch new projects and release existing inventory for sale. The geographic diversification has paid off this quarter as well, with Kerala contributing about 16% after the release of new towers in Marina One in Kochi and Sobha Metropolis in Thrissur. NCR has been consistent and contributed 22% of the sale value. Bangalore, GIFT City and other cities continue to be steady. We have a healthy pipeline of about 15 million square feet expected to be launched in the next 2 years, starting from next quarter. This, combined with our existing inventory of about 5 million square feet, provides us enough opportunity to capitalize the current demand scenario. In addition to this, we are of course working to in existing own land bank, current arrangements with the landowners and new opportunities to project level. Our cash flow management focus continued this quarter also and has resulted in a net cash flow of about 70 crores, bringing down our debt. In this quarter, our margins, as you would have seen, have reduced, largely due to higher costs in real estate, projects that are being delivered with pre-COVID pricing and post-COVID costs. This would improve as we start completing the projects that are sold post-COVID, most likely from end of this financial year and beginning of next financial year. By the time, we will also complete some of the contractual projects which are of lower margin in nature. With this brief commentary, I would like to hand it over to Yogesh, our Chief Financial Officer, to give his commentary on the financial performance.
Good evening, everyone. Thank you again for joining us. Mr. Jagdish has already briefed about our business and operation as a whole. I will quickly go through some of our financial highlights and open the floor for questions. In Q1 for FY24, we have generated good cash flow. Total collection was up by 1% compared to Q1 23, and our cash flow from operation was rupees 192.8 crore. We have increased the pace of construction this quarter with outflow of 532 crore on real estate project being highest ever. This will lead to faster completion and revenue recognition of our current projects. Debt to equity decreased to 0.63 from 0.66 in March 23. Net debt was at rupees 1,569 crore. Corresponding to our revenue recognition during the quarter, we have handed over 1.04 million square feet. Total income for the quarter was 939 crore. Our EBITDA for the quarter was 96.7 crore with margin of 10.3%. As indicated, low margin is on account of donation of projects sold earlier than COVID period and constructed majorly post-COVID at inflated cost scenario. I would like to thank you for your participation, and now we can open the floor for the question and answer session.
Sure. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask questions, please press star and 1. The first question is from the line of Puneet Gulati from HSBC. Please go ahead.
Yeah, thank you so much, and congratulations on good cash flow collection once again. My first question is actually on the cash flow part itself. First is the JD partner payment seems to have gone up this quarter versus the sequentially previous quarter. How should one think about it? Are those payments also likely to go up, or where will those trend?
Good evening, Puneet.
Good evening.
Regarding the JD payments, yes,
Yeah.
Your observation is right. It's gone up this quarter because of certain pending payments which were accrued in the previous financial year but paid during this financial year, during this quarter. So hence there has been an increase. And going forward, I think this particular quarter it seems to be a little higher because we were paying some of the pending payments. Otherwise, it should be back to normal based on the actual sales mix between own projects and the joint development projects.
Okay, that's cool. Secondly, if you can comment a bit more on, what launches and how much launches should we see for this year? You indicate that we should expect launch only now next quarter. So should I presume Q2 will also not see any launches, and then Q3 onward something will come?
Yes, the 15 million square feet pipeline, we should see that we envisage that it should be launched in the next 2 financial years to me. And we had expected to launch projects starting from Q2 of this financial year. However, due to the changes in the government in Karnataka and because of reshuffling of the officers and corresponding changes, there has been a slight delay in the approvals here, and hence we think that there can be a little bit of delay. We initially envisaged that we could do launches of about 7 million square feet this financial year, and I think with the current scenario, I think that might be reduced, but we'll still try to achieve as much as possible.
Understood. That's helpful. And second, on the land monetization front, if you can give some more color around what progress have you made, and specifically what parcels of land should we see getting monetized or launched next year, this year?
Particularly the land that we have in Bangalore and a small part in Hosur, these are the 2 ones which we are continuously working upon, and we are making very good progress on both counts because we have been investing sequentially in terms of improvement, consolidation, and any pending approvals that are required, approvals in terms of land or conversion and so on and so forth. So those should come into the pipeline. As and when they become they satisfy our criteria to be a project, and when we start our design and initial approval process, we will add to that inventory, and we should start seeing improvement in that from the next quarter.
So within Bangalore, if you can give more color, is it Hoskote that you're talking about essentially that should be or with Electronic City or Panut will come earlier?
Yes, it is Hoskote. It is several of our earlier partnerships that we had in land, which we are closing out, which are in the due diligence process, and certain commitments to be done by the landowners. Once they get completed, those will also be coming into the development stage.
Okay. And for those partnership, those are not a part of land bank, and have you already paid for that, or do you still need to pay for those?
Those have been a part of the land bank earlier.
Okay.
Some of them were part of the land bank. However, there were certain commitments to be fulfilled by the landowners, and also certain activities to be done at the land level, so that they can come to a project development stage. So those activities are rapidly making progress, and we should start seeing them, which are currently not in the launch pipeline.
Understood. That's helpful. And lastly, your Dreammaker is pretty much coming to an end of dream run. What project should we expect should replace momentum of Dreammakers?
Good question. In fact, last month we sold out the last unit of Dreammakers. We sold 6,262 units, and which are of 1 bedroom and 2 bedroom. There is a small area that's still left out, but those are of larger configuration, which we will release subsequently. Despite that, despite the reduction in the inventory in the Dreammakers, as you would have seen in Q1, we have still done 1,464 crores, which is slightly higher than the last quarter and still did better. So the projects that are filling up that void are Town Park, which we have here, and also 3 other projects that we launched last year, which is Victoria Park, Sentosa, and Royal Crest. And we also have certain inventory in Dream Gardens. So all of those have started picking up very well. So as you know, that the launches in Bangalore also have been little delayed. There is a certain inventory. There is some kind of the inventory is lower than what the demand seems to be, and hence it is helping us push the other projects towards sale. That is one. That is for the immediate one. For the future immediate in the vicinity, we have new projects coming up. One of the large projects that we are expecting is in Panakpur, which is of about 3.4 million square feet. If that comes in within time in the next quarter, then that should pick up the increased volume and sale value.
Oh, that's wonderful. Thank you so much. All the best.
Thank you.
Thank you. Before we take the next question, we'd like to inform participants that in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to participants. The next question is from the line of Rushabh Shah from O3 Securities. Please go ahead.
Hi, am I audible? Hello?
Hello, Rushabh. Yes, you are, but it is little muffled.
Okay. Sir, my first question is, our operational performance has improved quite materially in the last 3 years. Debt has reduced both in value term and also as a proportion of equity. But our credit rating has not improved. can you elaborate why so we are still at A+ only?
No, good observation, Rishabh. The credit rating is a combination of course, debt and also margins. So given that even though it's the nature of probably real estate being most unique, where the margins are showing up little later, so that is not getting reflected in the current P&L, and that's one of the reasons. And I think as we improve on those fronts, it will definitely improve.
Okay. So my second question is, if we look at the value of unsold stock, which is 4,251 crores, which is nearly equal to the sales we did in the last 9 months of the financial year 23. It seems that new launches are extremely important to grow. So on the forthcoming launches of 15 million square feet, how much can we bring in the next 6 months? The second part of the question is, are we thinking of raising prices more significantly as we have so low levels of inventory to sell for the time being? If not, then why not, sir?
Yeah. Like we have just mentioned, the remaining forthcoming launches of about 15 million square feet, we are trying to do about 6 to 7 million square feet this financial year, starting from next quarter. If you specifically ask for the next 6 months, hopefully we should be able to do about 4 to 5 million square feet. Depending on of course, all of this is subject to our ability to get the approvals, and most of them are in the advanced stage of approvals. And second question related to the pricing increase, with the pricing would definitely improve with the mix of the new launches and the existing inventory. From the current levels, I think it's going to be stable or marginally increased from here.
And so, last one, we are backward integrated company. How big a challenge can it be to take our real estate business to 8 to 9 million square feet in the next 2 to 3 years?
Sorry, Rishabh, I could not get the question. Can you please repeat?
Sir, we are a backward company. How big a challenge can it be to take our real estate business to 8 to 9 million square feet in the next 2 to 3 years?
Okay. This is from a delivery point of view, right?
Yes, sir.
Yeah. So backward integrated model is where actually it is we are very much poised to very much structured to deliver higher volume as well. There are two things that have happened. One, of course, we continue to invest in our own people and ability to form more structured teams as the delivery volume picks up. Second is, as we are focusing far more on real estate, some of our contract teams have also started contributing to the delivery of the real estate projects. So both put together, I think we are in a good position to take up the delivery to the next level. Having said that, it is not as easy as what we can say, but our continuous effort is to make sure that we deliver in the same model.
Thank you. Participants, please limit your questions to participant. The next question is from the line of Ravesh Qazi from Nuvama Group. Please go ahead.
Hi, good evening. Thanks for taking my question and congrats for great set numbers. Two questions from my side. First, on the market. Clearly, the trend which we are observing across the board is a good demand for high value items or luxury items, which is evident in your numbers also. Just wanted to get your views on another segment, especially the income segment, and how will our product mix change in future with regards to this change in user behavior.
Good evening, Parvez. our sales mix for quarter one, if we see the split of the ticket size, the more than 3 crore ticket size sales contributed to 37% of the sale, versus the same thing about 8 quarters ago, which is about 2 years ago, it was contributing to less than 5%. So that's a big change, and that has really helped us in increasing our sale value. And it is clearly coming from the demand side as well, and which we could quickly capitalize on that. The demand for larger houses seems to be the trend, and hence our inventory, the future inventory and the current focus is going to be on that. While the one side there is a demand for larger houses, the second side, the ability to fund that by the customers is also seems to be equally strong, even in this at this interest rate regime. Hopefully the increase in the interest rates are a past in nature. So hence, going forward, it should be even better as the incomes continue to grow.
Sure. Secondly, in terms of cash flows, obviously the debt has declined significantly over the last 10-11 quarters, and we continue to make positive cash flow at the net level. How do we foresee our cash flow generation and debt reduction going ahead, let's say, in FY24 and FY25?
We have, consciously we have reduced the debt, mainly from operations, from the last almost 2 years, 2 to 3 years. And that conservatism in terms of cash flow would continue. The reason being that we think that the future launches and the corresponding cash flow that we can accrue, we can now clearly balance out between both growth and being fiscally prudent. Of course, if the market continues to be strong and we start seeing far more opportunities which we can capitalize far more, then we would start allocating more capital to growth as well. However, the trend for the debt should be down.
Thanks. That's it from my side, and all the best to you.
Thank you.
Thank you. The next question is from the line of Pritesh Sheth from Motilal Oswal. Please go ahead.
Yes, thanks for taking my question. First is on launches, as you alluded earlier. So 6-7 million square feet this year and 15 million square feet cumulatively in next couple of years. How do we see trajectory beyond that? Because every quarter you have been adding projects in pipeline. Last quarter was 13 million square feet. Now we are looking to launch 15 million square feet. So what sort of pipeline you are closely working on, which can hopefully get to the launch pipeline, in coming quarters and boost our launches beyond just 2 years that we have set for?
Yeah. Good evening, Pritesh. So, like we have mentioned, we are continuing to work on bringing the existing land bank and the current arrangement with landowners towards the project development stage. But as and when we make progress there, we will continue to add, and that also is going very strong. Unfortunately, I will not be able to share the details immediately, but as and when we do that, you will see that coming in the pipeline.
Sure. Just broader idea would be to obviously increase this 7 million square feet to eventually 9-10 million square feet in the next 2-3 years, because that's what we are planning for in terms of our sales as well, right?
Absolutely, you're right. We have last year we did about 5.65 million square feet, and we are expecting to do better this year. And in the medium term, we would like to move towards 7 to 8 million square feet. And in the long term, if everything works out well, then definitely we should aim for about 10 million square feet. And correspondingly, the pipeline should reflect that. and we are working towards the same.
Sure, got it. And secondly, on the land investments, we had a small payment this quarter. Was it for any new land which was tied up, or was it for existing land? And what is our target in terms of land investments this year, next year, given that debt is much under control now? So your comments on that.
This quarter, the land payments that we have done are largely for the earlier commitments. Going forward, I think in this financial year, we might end up doing anywhere between 250 to 300 crores in terms of land investments.
Got it. That's helpful. That's it from my side. Thank you. All the best.
Thank you. The next question is from the line of Biplab from Antique Stock Broking. Please go ahead. Biplab, you may go ahead with the question.
Yes, thank you. Good evening, everyone. Congratulations on the excellent result. And my first question is on the contractual and manufacturing business. Sir, what will be the trajectory of contractual and manufacturing business? I mean, what kind of growth and what kind of EBITDA margin shall we expect in this segment going forward?
Good evening, Biplab. The contractual and manufacturing business, we have been mentioning that the growth, what we are seeing there is in terms of the overall contribution to EBITDA and gross margin and EBITDA. So our current focus in this financial year is to complete the projects what we have in the pipeline within the budgets that we already have, and make sure that our margins are reasonably protected. We are also looking at new opportunities very conservatively in terms of where we can, if these cash flow positive, net working capital always be negative, and also margins be more than double digits. In double digits. So those kind of opportunities, as and when we are seeing, we are continuing to take up those opportunities. So, but from a significant growth point of view, today that visibility is not as high because the current order book we have is we would be exhausting that in the next couple of years, and we are working towards one or two serious bids in terms of civil contracts. If those come through, then we would be very steady. From a manufacturing point of view, manufacturing has been very steady, and some of the manufacturing divisions are doing exceedingly well. One of that is our glazing and metalworks division, which had the highest turnover last year. However, there also we had challenges in terms of increased costs that we are trying to manage, and again there also we are trying to see how we can take up new projects and deliver against the costs that we expect from that. There we have a gross margins of over 20%. But in the overall manufacturing business, we should continue to see incremental growth.
On the land bank that you have, sir, excluding forthcoming projects, could you give us some color on the key land parcels and what size? And I mean, you have given indications how we are trying to bring a few of those land parcels to development stage. But can you give us some color, as in what kind of land parcel and on the key and what locations and what are your plans on those monetizing those land parcels?
Yeah, I understand the requirement of the question, Biplab, but unfortunately right now we are in the process of consolidating, in the process of making whatever is the existing arrangements work, and we would like to be a little bit more methodical in terms of disclosure also, as and when it comes to project development stage. that's when we would like to probably disclose. And hence, given that constraint, I cannot clearly mention what the numbers are. But like I had responded to Pritesh, our overall goal is to grow from where we are in terms of sales run rate. And corresponding to that, there is a requirement for us to increase the inventory, and we are working towards getting that kind of inventory. And we think that an inventory of about overall inventory of about 30 million square feet for a run rate of a sale of about 10 million square feet every year should be visible for us. And currently there is 20 million, and we will have to increase it at the right locations to make sure that we achieve that run rate. So we have a model, and we have a certain activity that we are undertaken to get to that level. But given the current stage where we are, we will be able to keep adding to that pipeline as and when things progress. Hello, Biplab?
And all the best, sir.
Thank you, Biplab.
Thank you. Next question is from Mohit Agarwal from IIFL. Please go ahead.
Yeah, hi, thanks. And congratulations to the team on 11 quarters of net debt reduction. My first question is on the collection. So, collection seems to be between 1,100-1,200 crores per quarter on a quarterly basis, while your sales, gross sales have moved up 1,400 plus in the last quarter. So, when should collections also move up at level? Should it be like next 1 or 2 years or longer?
Mohit, as the construction progresses in these new sales that we have that have occurred, those collections also should improve. And I think sequentially these cash flows are dependent on not just on new sales but also progress on the achievement of the milestones. That as we are increasing our real estate spend, then we should surely aim to achieve those collections as well.
Is there any timeline on this? Any 1 or 2 quarters we see this moving up?
That's a very incremental as we progress. So it's not very clear that there is in another quarter or couple of quarters it's going to improve. There will always be a little bit lag because most of the sales that are happening are, if the sales improve, a majority of the sales collection would come in. I mean, the initial collections are not as high. And so it is always a mix of new sales versus the old sales construction. So given that, it's a little tough for us to estimate how much would relating it to the new sales. So overall collections should improve because we are accelerated the pace of the construction, but the timing of it will surely improve. Maybe even next quarter, next quarter. But directionally, it has to happen.
Sure. And sir, on your reported P&L, last quarter there was a lot of discussion around, why the margins are weak. Just wanted to get a sense, when could we see the P&L EBITDA margins improving, and in what time can we see, they reaching that level where, that level which reflects current market that you'd be talking in?
So we would start completing the projects which we sold post-COVID, and not just post-COVID, but in FY22 or so, from end of this financial year to the next, starting from next financial year. That's when the mix would start changing towards those sales. And so hence slowly the mix would tilt more towards the post-COVID sales. As and when that happens, the margins are set to improve.
FY25 onward, right?
Yeah, FY25 onwards, the mix of the projects that would recognize the revenue would start coming in, and hence the improvement should definitely be seen.
Sure. And sir, just one clarification on the previous question on the Dreammakers, the sale of Dreammakers. This segment, Dream Series, has been clocking in 2025 sales for you, the sub 1 crore segment. You have mentioned some projects will replace that, but as a segment, as Dream Series segment, do you consider contribution to continue at 20-25%, or will the mix change towards more premium products?
Yeah. Definitely the mix has, from the sale value, it has changed towards the larger ticket sizes, as you have seen in the overall split of the revenue over the quarters. But however, having said that, the sub 1 crore or near about 1 crore is a very important segment for us, because that has been contributed to the sales for the last several years, and that's a segment that we would like to continue to cater. But at the same time, we are not envisaging a single project to have that. But in each of our current projects that we are designing and we are preparing to launch for, those we have catered to those ticket sizes also in each of these projects. So we might not say it as a Dream Series, but from a size and the market segment point of view, we will address those also. And additionally, apart from these Dreammakers, what we have, we currently have Dream Series projects in one more project which is called Dream Garden in Bangalore. That is also continuing to do well. That caters to the current market segment in that ticket size.
Understood, sir. Thanks a lot.
Thank you. Before we take the next question, I remind participants to please limit questions to two participants. The next question is from Kunal Lakhan from CLSA. Please go ahead.
Yeah, hi. My question. Firstly, on the volume side, when I look at your volumes, overall volumes have quite steady over the last, 4 quarters. If I look at Bangalore, right, in terms of absolute volumes, it kind of dipped, steadily in the last. Anything to read over there? Like, are we seeing any kind of consolidation, slow down in the IT hiking, or say, the salary hikes we have seen in years? So, anything to read over there?
Yeah. Kunal, the Bangalore volume, last financial year, first quarter was the best in terms of volume, where we did 1 million square feet. And that's what I think we should go back to at least. The main reason for the slight reduction in the volume or the sales area that we are doing in Bangalore is directly linked to the launches that we are doing. And as the launches improve, the volume there should definitely improve.
It's normalized back to like 1 million square feet.
Yeah, it is that.
Sure.
We think that the market is larger than that, but given what we have today, that at least we should do. And as we progress for new launches and across the various locations in the city, it should get even better.
Sure. Thanks. The question was on more of a clarification on the news that goes, the allegations that go in the media, the social media regarding land deals with private developers. Firstly, I just want to understand what is our official stand on this, and secondly, have we heard anything from the regulators or the government bodies for the income tax rate that we saw earlier this year?
That particular article, we had contested that article and we have filed a defamation case, post which we got a favorable order from the court, and the author of the article and corresponding linking articles have all been taken down. It has got nothing to do with any official regulatory or government bodies. It's an article published by independent journalists, and once we came to know about it, we have taken a swift action against it.
Sure, great. Just again clarifying one thing, that the land parcels which were bought along with the aggregator, we wouldn't have any challenges in bringing these land parcels to the market in terms of new land, right?
Yeah, these land parcels are largely in Kerala and in Tamil Nadu, which were bought in the years between 2006 to 2009. So we have been these lands we have been working on these lands to make them developable or find the right usage for it. And as and when we do that, we should be able to deliver. Right now, I don't see any challenge in terms of monetizing those lands, from a legal and legal title standpoint.
Sure, and again, like just to follow up, the same articles were cited that land parcels would be 1,500 acres. That sounds a little exaggerated, but just your official comment on that.
Sorry, Kunal, can you please repeat the question?
Sorry, just a clarification that the same articles were saying that these land parcels were tune of about 1,500 acres, which seems a little high, but just your comments on that.
Well, that seems to be little on the higher side for us too. But we have acquired lands in Kerala and Tamil Nadu, both of which we see those, and they are very low cost in nature considering the locations where they are present. Those should be in the range of about 800 odd acres. We can come back to you with the exact detail.
Sure. Thank you so much, Jagdish, and all the best.
Thank you, Kunal.
Thank you. The next question is from the line of Abhinav Sinha from Jefferies. Please go ahead.
Jagdish, hi. Few questions. So, given the change sort of view on new launches, what is the pre-sales guidance look for the year? I believe earlier you said 6-7 million square feet, then 15-20% possible. So, I'm still hoping for double digit.
Good evening, Abhinav. We continue to aim for it, despite a little blip in the launches.
Okay. And secondly, the margin trajectory, I just wanted to check. So, this quarter, and even if you look at last quarter, started hitting and crossing the 10K per square feet level. So, what is roughly margin we should be expecting in this portfolio today? I mean, the one performance we saw in P&L was, pretty weak. So, what should we hope for?
The new sales that we are doing at the current pricing, Abhinav, we should expect gross margins of 35% plus.
Okay. 35 versus what is of 50 to 20. Is that the right number? Right?
Yeah, it's about 20%.
20%. And what is your stake in pipeline now, on average?
Is
it like 7%, or is it like much lower?
For the remaining the revenue that is going to be recognized?
No. So, on average, what is your ownership of projects that we are seeing being sold?
In the new pipeline, in 15 million square feet?
Yeah. Or even
that
what was
would
sold
be,
in 1Q. Or even what was sold in 1Q. Any number, yeah.
I mean, for the forthcoming projects, which is about 15 million square feet, our share, blended, should be about 80%.
80%. Okay. And thirdly, on the net debt question, so, again, it's been a great job to see how it moved. Is there a gearing target that we are hoping to, hit, let's say, 0.5x something? or we are by and large going by as per our?
Abhinav, we do not have any specific target in mind, but we believe given the nature of the business and what we have already invested for since inception, and we have this large land bank, right? So I think we should be able to feed in our growth from all the pipeline that's going to come in, and hence the debt that we are looking, we do not have any specific number, but like I said, the trend is down, and ideally for a real estate mature business, it can go to 0 too.
Okay. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Parikshit Concall from HDFC Securities. Please go ahead.
Hi, Jagdish. So my first question is on the launch of 15 million square feet. I want to understand how much of is our own land, captive land, and how much is the third-party land?
Like I was just saying, a blended of that would be about 80%, 20%.
No, that I understand. So once you've acquired the land, it's your land, but I think pure, that was a part of your land parcel. So, after this 15, you would have bought some land also, right, which would be right on your name. Last 2 years, if any acquisition is in this land, or it's just 15 million or 80%, that is entirely historical land bank?
It's largely historical, and any new land that we have acquired, that's not yet part of this, not yet part of this pipeline.
How? I think I understand last year you did about 300 crores of land, and in this year something would have happened last year before that also. So those land parcels, so what could be beyond 20 million? 15 new and 5 earlier ones. So what could be potential which right now is residing on the balance sheet but yet to be brought in terms of the launch potential?
Like I was saying, Parikshit, we are still working on it in terms of when we can, once it comes into the project development stage, we would add it into the pipeline.
Because how much time it takes for you to, when you buy and bring it, because I think these new land parcels outside the group should be having a very short term or maybe 1 year, within a 1 year time frame kind of launch, right? So you would be broadly having some sense on what potentially the sales area.
Yeah. That's it. For a smaller land parcels, that's it. We could quickly get in. But for a slightly larger land parcels where it's being jointly aggregated or where there is some sort of cleanup still required, we are not yet bringing that into the development stage. So hence, probably in a quarter or two, we will be able to start declaring those as well.
That will also be significant, right? If you're saying these are large parcels that can add significantly to the current portfolio of 3 million, right?
Yes. And that's exactly, I reiterate, is that if I have to build in a pipeline of, we have to get to a run rate of initially from current to about 6 million to 7 to 8. Correspondingly, the pipeline has to, the inventory also needs to go up correspondingly.
The second question is on the credit rating of the parent company. I've seen they've done last year FY2023 figures of almost 2,000 crores in rupee terms, pre-sales, and this year, I think in 5 months, they've already done 1,000 crores. Some number, I think this year, annualized itself will cost 30,000 crores, so which is like the no one does kind of scale in India. So given that kind of scale, and I think that's a margin what they have put the rating agencies about 3,000 crores. So what does it mean for us in India, given that are doing super or extremely well in Dubai kind of scale they have demonstrated? So how can we get some touch of that in Indian operations? How do we envisage either any financial sense or any scaling of the current on the scaling of the current India business? So how do we learn from them?
So the good news there, is that the Dubai business is doing exceedingly well, and that gives enough cash for the promoter group also to have a choice of investing in India as growth capital, and that would happen as and when it is necessary and the right opportunities buy. It's still the sales have happened there also, but I think the cash flow etc. is going to take a year, couple of years. So as and when things improve there, definitely we should see a positive repercussion in terms of ability to probably contribute from them in case we go for a capital raising here.
Okay. So if anything it does happen, so it's capital raising, so it will happen to the listed entity at all. I mean, they cannot obviously come directly at the at the level. They will do some kind of, maybe if at all, use what kind of capital raise or something like from the parent. It can happen.
That's the current thinking. As and when things improve or change, of course we will let you know.
Okay. Okay. Thank you, Jagdish, and wish you all the best.
Thank you.
Thank you. Next question is from the line of Dhruvesh from Prospero Tree. Please go ahead.
Yeah. So basically, 1.5 million is very easy, right, in terms of per quarter. So 6 million can be a minimum guidance that we can take.
Dhruvesh, like I've been saying, it's largely a function of the new launches, and in the first quarter itself we have seen that there has been a little bit slip in the launches, but we are still aiming to cover up that. And from a volume or from a value point of view, we should do better than of course last year, and that's what we are aiming to do. From a sales, the area point of view, we are looking at much better improved pricing from last year as well. So if we can do better in the area as well, nothing like it.
Okay. And sir, you said possibly we are targeting, not targeting, but if things work out, it can even become a zero debt company. Would you rather not say that we will aggressively then search for the land or projects, or no? That is completely dependent upon what kind of markets we are in and what kind of opportunity comes.
Yeah. Yes, Dhruvesh, that is a very far off scenario right now. So hence we can deliberate upon it as and when things progress in that scale and the kind of opportunities and the markets that we would be in. So we, as far as debt is concerned, right now our thinking is that we are in much better situation. Hence our ability to decide based on the requirement is very flexible, and hence like I said, there is a possibility of zero also, if there is a possibility of just continuing to maintain the same debt level. So both possibilities exist based on the external environment, opportunities, how we execute against our plans, all of those.
Thank you, and sir, best of luck. Pleased to hear, and the kind of comments that you have been sharing is lovely. Thank you.
Thank you, Suresh.
Thank you. Next question is from the line of Vivek Kumar from Best Pals Research Advisory. Please go ahead.
Hi, Jagdish. You just mentioned half an hour back in the call that the medium term we will go to 7-8 million, and then from there we have to 10 million. Long term, so if you can set a timeline, I'm not asking that guidance, but in your what is long term, what is medium term, and related question, you have to go to 10 million or like go 50% or whatever is your internal target into every year. So do you think that, I'm assuming, if I'm wrong, correct me, I'm assuming that a lot of growth has to come from rest of Bangalore, because Bangalore can't keep being large of if you really need to grow in the long run. So which cities do you think are more positive on where you are increasing your business development? If you throw light on over 10 million mix from there, which is you are more aggressive and you are putting your next set of investments? So, two related questions. If I made my clear.
No, thank you, Vivek. The Bangalore itself, we think that the potential is larger than what we are already doing. That said, the other potential markets where we are already present and where we think that the scope for growth is NCR. The other two markets where we are present but in a very small manner are Pune and Hyderabad. We will try to see if we can increase our scale there. It is also now becoming increasingly difficult and tough to take calls on, given that the land costs also have gone up quite a bit. So, given that environment, it is from a capital allocation point of view, we are choosing to invest where we can get our best returns. And given that the mix right now, it's whatever current mix we have, I think that would probably continue in the sense from in these large locations, which is Bangalore and Kerala, Pune, Hyderabad, and NCR. Of course, Bangalore being the largest, and NCR being coming second, and third and fourth being Pune and Hyderabad.
Okay. And this you have said medium term and long term. So can you some upper limit of the time? I'm not asking exact number here.
Well, Vivek, as we get confident in terms of the inventory and the ability to launch, we will definitely share that. That's our aim right now.
Thank you, Vivek. Thanks, Robert.
Thank you, Vivek.
Thank you. The next question is from the line of Neil Kulati from HSBC. Please go ahead.
Yes, thank you so much once again. You also alluded that one of the reasons your margins show up poorly is because of the old sales which are getting recorded. And last year you also evaluated your accounting changes. What are your thoughts on moving to a percentage completion method or project completion method? Some of the other developers have done. What stops you from doing it?
I would have Yogesh respond to that. Yogesh?
Largely, people have moved POC in Mumbai, right? One or two developers we heard that they have moved to POC.
Correct. But they also have projects across.
Yeah. So basically, they are following POC and they are entering into non-cancelable agreement and stamp duty payable at the time of agreement itself. Whereas in risk and reward, we are recognizing revenue based on risk and reward transferred to the customer.
Right.
So in our case, risk and reward is getting transferred once we complete our obligation and receive entire money. So we continue with as of now, we are continuing with our completion methods.
There are two parts to it, Puneet. Actually, one is, of course, technical, which is what Yogesh has just mentioned. Which is, and we have been following a percentage completion method several years ago, before the Ind AS regulation has mandated us to change this. For an ongoing real estate business, I think the COVID and the cost inflation, which was dramatic, is something which is I believe is like a black swan event. Other than that, whether you follow POC or whether you follow the revenue recognition at the completion, both on a run rate basis, it should not matter too much. Currently, what we are doing is we are just laying out whatever is the actual right now. If I follow POC, probably some of those things get again averaged out. So in the long run, I don't think it should matter as much.
Understood. Thank you so much.
Thank you very much. That was the last question in queue. I would now like to hand the conference back to the management team for closing comments.
Thank you. I express my sincere gratitude to all the participants in the call today and for your patient hearing. I hope we have answered some of your questions satisfactorily. In case of any further questions, please do reach out to us. Your queries and views have always helped us to improve. We look forward to a good operational and financial performance in the remaining quarters of FY24 with an optimistic outlook towards the economy and the industry. And as I have been mentioning, Sobha is very well positioned to grow with a disciplined operational and financial model, while we think it is being set up for building and scaling in the long term. We will continue to pursue our goals with passion. And thank you, everyone. Wish you all a good evening. Truly appreciate your support.
Thank you very much. On behalf of ICICI Securities Limited, I conclude the conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.